Hi, this is Charles Hoskinson broadcasting live from warm, sunny Colorado. I have to go take care of some things today, but I wanted to make a brief video because I actually have an interesting tax question that I hope the Canadian tax expert can answer, because every tax system is a little different. There was a recent event where a large amount of money or crypto was gifted unsolicited to Vitalik Buterin, and he decided to pass that through and donate all of it to, I think, COVID relief. And the question I have to a Canadian tax expert, if this was done in the United States, we have something called a lifetime tax exemption. It's about $11 million. But if you go above that, then gifts to an individual are taxed at, I think, a 40% rate. I'll have to double check. But it's actually taxed. So there's a tax event to move the money from Alice to Bob. So in this case, from one protocol to another. And then when one donates, that's not necessarily in all tax systems completely tax deductible. So it's an interesting tax question I have. Is this entire pass through from the creator to Vitalik to India a tax neutral event or a tax negative event or a tax positive event? And it brings up a very broad and interesting question, which is an attack that a person could do under US tax law. You know, when we have an adversarial mind or information security, we always think about these things. So hypothetically, we could create tax bomb coin and then trade it on a very small exchange to create an unrealistically high value. So even if a few dollars trade, you could still create a multi-billion-dollar value for a coin and then give all of that to a person you don't like. And technically under US tax law, that may be an income event for them at the value of that particular token. So it is a really interesting thing. So I'm not exactly sure what U.S. tax law has to say about this and what Canadian tax law has to say about this, but it's showing you something that our tax systems are actually not designed for cryptocurrencies. Many people don't understand, for example, in the United States, when you transfer a cryptocurrency from one individual to another individual, let's say I have a Bitcoin and you give it to your friend Bob, that's actually a tax event. It has a capital gains or capital loss because you've realized value from when you acquired it or lost value from when you acquired it to when you're gifting it to somebody else. So there's all kinds of interesting things there for purchases and for gifts. And this is actually a very fascinating event for me because it's kind of a broader conversation of how do taxes handle the fact that things can have this insane inflated value, but not actually have liquidity or the ability to realize that value. This is especially true for proponents of wealth tax. So if you are a big fan of, if you have more than $50 million of assets or $100 million of assets, you should pay 5% of your wealth every year to the government. So Elizabeth Warren, for example, is one of the wealth tax pushers. Well, technically, one could have hypothetically hundreds of millions or billions of dollars worth of a crypto, but let's say that cryptocurrency has no liquidity. So you're actually owe a lot, but you actually have no ability to realize that. And that's one of the arguments against the wealth tax, especially for when people hold illiquid securities. But cryptocurrencies are not generally treated as securities for tax purposes, nor are they treated like commodities or other exempt things. So all those tax structures that we've enjoyed in the 20th century, from stock options and other things, actually don't work in cryptocurrency land. So if a tax lawyer or tax expert in Canadian or U.S. tax law can actually comment on this, I'm really curious to see how it works from that system. And in general, has this actually ever come up before? It's such a large amount of money. It's something that a tax authority kind of has to care about. Over $1 billion of assets transferring, even though we all know that there's really not $1 billion, because the minute you start selling that, the price collapses. So maybe the fair market value is something else. But how then do you account for a fair market value for a semi-liquid asset that's trading? It's a very fascinating question, and that's why I brought it up. And I hope you guys can cogitate with it. Anyway, I got to get going. Have a wonderful day, everyone, and I look forward to your answers. Cheers.